I think of savings in tiers. The first tier is to secure your well-being, to own a portfolio of assets that are going to secure your well-being.
In the world of finance and investment, few names command as much respect and attention as Ray Dalio. As the founder of Bridgewater Associates, the world's largest hedge fund, Dalio has built a reputation for his keen insight into global economic trends. His recent warnings about an impending collapse have sent shockwaves through the financial community. Today, we're going to dive into Dalio's prediction and explore the potential far-reaching effects of the collapse he envisions. Ray Dalio is not one to shy away from making bold statements about the state of the global economy. With decades of experience and a deep understanding of economic cycles, Dalio has formulated what he calls the Dalio Doctrine. This doctrine is built on the premise that economies, like all complex systems, follow certain patterns. By studying these patterns, Dalio believes it's possible to anticipate and prepare for major economic shifts. Dalio's warnings of an imminent collapse are grounded in his analysis of several key indicators. Rising income inequality, mounting government debt, and unsustainable monetary policies are among the factors he points to as signs of a looming crisis. Additionally, the increasing polarization of political and social landscapes in many countries adds to the volatility of the global economic environment. One of the key factors contributing to the impending collapse, according to Dalio, is the widening gap between the rich and the poor. As wealth becomes concentrated in the hands of a few, consumer spending, which is a significant driver of economic growth, stagnates. The inequality not only undermines social cohesion, but also hampers the overall economic stability of nations. Governments across the globe are accumulating unprecedented levels of debt. This debt burden, when coupled with slow economic growth, creates a precarious situation. High levels of debt limit a government's ability to respond to economic downturns effectively. In the event of a crisis, countries with substantial debt may find it challenging to implement stimulus measures, potentially exacerbating the depth and duration of the collapse. Central banks have responded to economic challenges with unconventional monetary policies, such as low interest rates and quantitative easing. While these measures provide temporary relief, they have also inflated asset prices, leading to market bubbles in various sectors. Dalio argues that these policies are unsustainable in the long run and, when unwound, could trigger a severe economic downturn. Inflation. The rate at which the general level of prices for goods and services rises has been relatively moderate in recent years. However, Dalio's warning highlights the potential for a rapid increase in inflation, which could have far-reaching consequences. Rising inflation erodes the purchasing power of money, leading to higher costs for consumers and businesses alike. Central banks may respond to inflationary pressures by raising interest rates, which in turn could hamper economic growth and investment. Additionally, inflation can create uncertainty in financial markets, leading to increased volatility and investor anxiety. Ray Dalio's concise yet profound statement encapsulates the essence of the looming economic challenges faced by the world. His assertion, we have a lot of debt, we have a lot of central bank intervention, and we have a lot of wealth inequality. These are all ingredients for a collapse, underscores the critical factors contributing to the fragile state of the global economy. If Dalio's prediction materializes, the effects would likely be felt far beyond the realms of finance and investment. A significant economic downturn would likely trigger a global recession, leading to widespread job losses, reduced consumer spending, and diminished economic growth across countries. Economic hardships often breed political unrest. Citizens delusioned with their government's inability to address the crisis may take to the streets, demanding change. This could lead to a political instability and even regime changes in some nations. A global economic collapse could disrupt international trade, leading to protectionist policies and trade conflicts between countries. Tariffs and trade barriers could rise, hampering the flow of goods and services across borders. Economic crisis can strain social safety nets and charitable resources, making it difficult to provide assistance to vulnerable populations. This could exacerbate poverty, hunger, and healthcare challenges, particularly in developing countries. In times of economic uncertainty, businesses tend to cut back on research and development expenditures. This could result in slowdown in technological innovations. Economic downturns can also impact environmental conservation efforts. Funding for environmental initiatives may be redirected to address immediate economic concerns, potentially slowing down progress in combating climate change and protecting endangered ecosystems. Economic crises often lead to shifts in geopolitical alliances and power dynamics. Countries may reassess their alliances and partnerships in an attempt to secure their interest in the face of economic uncertainty. Economic instability can have a profound impact on mental health. The stress of financial insecurity, job loss, and uncertainty about the future can contribute to a rise in mental health issues such as anxiety and depression. Ray Dalio's advice to investors, urging them to brace for the impending collapse, reflects his pragmatic approach to navigating turbulent economic times. By emphasizing the importance of diversification, maintaining a cash cushion, and considering investments in assets like gold that tend to hold their value during crisis, Dalio provides a strategic roadmap for investors looking to safeguard their wealth in the face of uncertainty. Diversifying investment portfolios is a fundamental risk management strategy. By spreading investments across various asset classes such as stocks, bonds, real estate, and commodities, investors can reduce their exposure to any single type of risk. Diversification helps mitigate potential losses in one area by balancing them out with gains in another, enhancing the overall stability of the portfolio. Maintaining a cash reserve is a prudent financial practice, especially during uncertain economic periods. Cash provides liquidity, allowing investors to capitalize on opportunities that may arise during market downturns. Having a reserve also offers a buffer against unexpected expenses and ensures financial flexibility when navigating economic uncertainties. Gold has been long considered a safe haven asset during times of economic turmoil. Its intrinsic value and historical significance make it a reliable store of wealth when traditional currencies and financial markets are volatile. Investing in other stable assets, such as government bonds from economically stable countries or dividend-paying stocks from robust industries, can also provide a degree of stability to a portfolio during turbulent market conditions. During economic downturns, certain sectors tend to be more resilient than others. Defensive sectors, such as healthcare, utilities, and consumer staples, often continue to perform steadily even when other industries face challenges. Investing in companies within these sectors can provide a defensive position in a portfolio, helping investors weather market fluctuations. Market conditions can change rapidly, and investor strategies must adapt accordingly. Regularly monitoring economic indicators, geopolitical events, and market trends enables investors to stay informed and make timely adjustments to their portfolios. Being flexible and responsive to changing circumstances is key to preserving and growing wealth during uncertain times. Ray Dalio's insight into the impending collapse is underscored by his cautious assessment of the time frame within which it might occur. While he refrains from providing a specific date, his acknowledgement that the collapse is more likely than not to happen in the next 5 to 10 years speaks to the urgency and seriousness of the situation he perceives. Predicting the exact timing of economic events is inherently challenging due to the complex interplay of numerous variables on a global scale. Dalio's reluctance to pinpoint an exact date is a testament to the dynamic and multifaceted nature of the global economy. If you enjoyed this content and found it valuable, please show your support by liking, commenting, sharing, and subscribing. Your engagement fuels our drive to bring you more informative and engaging discussions on topics that matter.